Okay, so now that we've talked about Section 3 on 4562, now we're going to go back up and talk about the other two sections, Section 1 and Section, there we go, Section 1 and Section 2. So there's a couple general rules. So first of all, anybody in a business can elect to automatically expense something that we call Section 179. Section 179 allows you to expense up to $1,020,000 of business, tangible, personal property placed into service in 2019. The interesting thing with this number is in 2018 it was $1 million, and in 2017 it was $500,000. So it jumped drastically. So if it's Section 179, you can expense up to $1,020,000. So if you placed Dr. Payne placed into service, it was under that. He can expense it all. All right. You cannot. Section 129 cannot be used for most realty or production of income property. All right. So, general rules, amount expense reduces your depreciable basis, which is the same thing depreciation does. All right. Any 179 taken before the additional first year depreciation, which I'm going to talk about after because this is taken first. And the base for calculating the standard MACRs, which is what we just did, deduction, is the net of all Section 179. So we have to go through and do 179, then we do additional, then whatever is left is what we depreciate. That's why on the 4562 that we just looked at, that's why Section 1 and 2 happen first, then whatever's left gets depreciated. So for 2019, the expense limitation is $1,020,000. It is reduced by any Section 179 property that exceeds the $2,550,000. So if you put in property that is more than $2,550,000, you have to reduce your $1,000,002. You're kind of penalized if you put in more than that. So for example, a taxpayer put in $3.5 million worth of Section 129 property. So he has $1,000,002, that's his limit. That $33.5 million, he subtracts the limit, so now $1,000,002 is reduced by $925. So you're penalized by putting in more. The Section 179 is meant to benefit those that are right around that $1,000,002 and under. So, or not the, I'm sorry, not the $1,000,002. Benefit those that are under that cap, the 2.5. So once you go above that, you're kind of penalized in getting the reduction. You're not penalized for getting the bonus deduction, and you're not penalized for depreciation, but the Section 179 has a specific audience that it's targeted at. So in this case, they aren't limited from getting anything, they're just reduced to only getting $925 instead of getting the whole $1,020,000. So their Section 179 is limited to $925,000.
So businesses where over than that, they cannot take more than the limit.
Right.
2 million.
So let's say that business actually had $7 million.
Okay.
They wouldn't get any Section 179 because their $7 million minus that 2.55 would result in being subtracted from $1,020,000 would result in a negative number.
This limit is just for this year. Can they retain for the next year?
Well, next year, if they had no more purchases next year, yes. Every year it starts over. All right, annual, it cannot exceed the taxable income, so that's something else. You cannot go forward with a deduction of Section 179 more than your taxable income. So, for example, you might have gone out and bought some really big things. You can't have $1 million deduction if your taxable income is only $150,000. Now, some people might be like, well, how can you go out and buy something that cost $1 million if your taxable income is $150,000? Well, just because your taxable income is $150,000 doesn't mean you didn't have money to spend. You can borrow money and go buy things, right? But your income might be lower. And we'll have an example. So, any amount expensed that is under the 179 limit can be carried over. So, if your taxable income is too low, and you can't use your Section 179, you can carry it over to the next year. All right? Amount carried over still reduces your basis. And then any section 179 that expensing in any carried over is limited to the lesser of either the $1,020,000 or the $2.55 million. So you can't carry over more than what is allowed. So let's look at an example. Jill owns a computer service store that she operates as a sole proprietorship, and her taxable income is $138,000. If Jill spent $2.73 million on equipment, her section 179 expenses are as follows. So first of all, there's her $1,020,000. That's her section 179. And if you look at your 4562, that's 2018, so it's only going to say $1 million. All right, the new is $1,020,000. So she spent 2.73. You subtract the 2.55, which gives her 180. Why is it only limited to 180? Well, that's what exceeds. So that's what's going to be her limitation. So what's left? She gets $840,000 of the $1,020,000. But her net income is only $138,000. So she can only use $138,000 this year, which means she gets to carry forward $702,000 to next year. Does that make sense? Just nod. Okay. So that's section 179. All right. So there's limits on that. It's meant for people in that target area or under. So additional first year depreciation was started a couple years ago. It is still here after the tax year changes, so that's a positive. And so basically what it says is you are allowed to take 100% of your cost recovery in the year that you put it in place. So that most people have taken advantage of. So it means that you can compute any immediate expense deduction. And so when you go through it, additional first year is taken in the year you claim it. First of all, it has to take the first year. If you don't take it, you don't get it. All right. So it is computed after an immediate expense of section 179. You can choose not to take section 179. After the additional first year depreciation is determined, then you figure out MACRs, which whatever is left. All right. A taxpayer may elect not to take additional first year depreciation. Now, are there reasons not to take it? Yeah. Sometimes taxpayers might believe that next year is going to have a higher income, and they might want to save some depreciation expense for next year to reduce their income. Or if they want to save, or they're not going to be able to save that depreciation, but if they want to save section 179 or keep some for a higher depreciation in years to come, that would be another reason also. Right? It just depends on how they want to do it. Do they want to average it out? Do they want to use it all in one year? How are they trying to strategize?
So they can choose.
You can choose if you want to take the first year's, if you want to take the first year's depreciation, and if you want to take, but first year's depreciation is only in the first year. All right? But if you don't take it in the first year, that means your MACRs is going to be higher. So that's going to help you have higher depreciation in the years to come. Okay?
Taxpayers can choose.
Taxpayers can choose that, yeah. And usually it's a strategy with net income in next year's. Or if you already have enough to write it off with section 179, then you don't need it either. Qualified property includes most depreciable assets other than buildings with a recovery period of 20 years or less. All right. Bonus depreciation applies to both new and used property, as long as it's your first time using it. So it can be used property as long as you haven't owned it before. So here's another example. So Kelly acquired a 5-year asset on February 1st at a cost of $1.3 million and elects to expense it under section 179. So keep in mind when you start doing your homework and different things, it's just going to say section 179, right? It's not going to keep telling you it's $1,020,000. So elects to do it under section 179. Kelly also elects to take the bonus depreciation. So the first thing you're going to do is section 179 is $1,020,000. So you're going to subtract the $1,020,000 from the purchase of the $1,345,000. All right. So when you do that, they have $325,000 left. and they're going to take 100% of what's left, which is 325. So in the end, they're taking 100%. So that, to me, is a complicated way of looking at it. What Kelly basically wants to say is that she is going to write off.
Sorry,
That's all right. I'm in class.
I know. Can you see me? I'll be in here when you get done.
Okay.
Because I'm locked out of this one.
Okay. All right. So you need to go and look at the fact that all they're wanting to do is to make sure that they write off everything. So the way they did that is great, and it kind of shows the steps, but you're taking the section 179, and then bonus depreciation basically just says write off the rest. They're showing you the 135 minus the 1,020,000, but they don't even need to say it. You're basically writing off everything. That's what it's allowing you to do, right? Alternatively, Kelly could elect not to take section 179 and just take the bonus depreciation to completely deduct it. So she doesn't, I'm assuming it's a she does not even need to take 179. She could just say, I'm taking the bonus depreciation, $1,345,000. So either one of those allows her to completely depreciate it, which allows her to have the expense on her income taxes, which is allowing her to minimize her income. Now, keep in mind, in the end, you can't go negative, right, on your business income. So that's going to be it. All right, so Dr. Payne.
So it's not like most you can take.
Right, right. You can't go below your net income with depreciation. So we turn to the facts. He assumes that Dr. Payne placed the $612,000 of assets into service. Okay, because this amount is less than $3.5 million, there is no reduction in the million of the section 179. So he can do that. And because he has sufficient business income to avoid the business income limitation, he can actually expense all of the assets put into place. So he can use the section 179 to basically take the whole $612,085 off. So it doesn't matter that we came up with the $91,085, the $45,000, or the $34,000 that we came up with, all the different methods that we used. He will actually be able to use the $612,85 and write off everything. And he can do that just with the section 179, but he could have done with the bonus depreciation too. So that's a significant way of being able to go in, and it was put up there to help small businesses. And remember, anybody that takes their business income through their own 1040 is supposedly a small business, right? They're not a big corp. So this was designed with the IRS design was to help small businesses, and this was one of those. Okay, so now this one is an example without additional first-year depreciation. So if the business income limitation comes into play, Dr. Payne can elect out of Section 179. So if he doesn't have enough money in income, he could elect out of Section 179 and could deduct the 612 using additional first year, which does not have any income limitation. So if you don't use Section 179, first year depreciation does not have an income limitation that we were talking about earlier. In this case, however, there's some other limitations that he might want to think about, including excess business loss limitation, which we talked about in chapter 7. Or he could apply the section 179 or additional first year on selected assets. So you could actually go one by one through your different assets to reduce his taxable income and defer different things. So then you really start getting and strategizing with your assets on what you want to do. Right? If he chooses to do neither one, then he's going to end up with that $91,000 that he had on the very first page. Because when Dr. Payne came up with his depreciation, when he first gave us on the very first page of the big picture, only thing he was doing was half year. That's the only thing he was doing. All right, if you look at your second page like I talked about, because that took us through the special deductions and the section 179. on the back page, part 5 talks about listed property. And listed property on the tax form as well on their screen talks about things such as passenger automobile, means of transportation, entertainment, recreation. Those are all things that can be purchased and could be listed on here. And notice it also says computers placed in act after 2007 are not listed property. All right, computers are not considered anything that would be long lasted after 2017. All right, so listed property has to be considered as predominantly used in a business. Business must exceed 50%. So when you're looking at a car or an aircraft or property used for entertainment or recreation, a boat, 50%, it has to exceed that 50% for business purposes. All right, use of the asset for production of income is not considered in the for 50% test. So they're not saying that it's producing income. So your car doesn't have to produce income. It has to be used in business. It has to get you places. All right. Both business and production of income use percentages to compute cost recovery. Now, to be considered as predominantly used, business use must exceed it. If this test is not met, then they allowed to use statutory method percentage of cost recovery with some limitations. I will tell you that the IRS got harder with some of these things on how often they're used, cars and such like that. So it is just best to try to meet those things when you're using items for recreation is what they call, and then cars and other recreational vehicles. If an asset is not used predominantly in business, so it doesn't exceed the 50%, then you have to use straight line, right? And if it falls below 50% or lower after a year placed in service, then you have to do what's called a cost recapture. And that's kind of a pain in the butt, but you have to go in and use a cost recapture. So straight line if it's below 50%, if it's above 50%, I'm going to walk you through what you will do. So automobiles placed in service in 2018, the cost recovery limits, notice it's saying 18, right? So they put in 18, used in 19. The cost recovery limits are for year 1, it's $10,000. So that's a lot of money. Year 2, 16, 9,600, and then 57,600 for every year until the cost is recovered. So think about you go and you buy a $40,000 car. So 10,000, 26,000, you're just shy of 36,000. So in year 4 you will have recovered the cost of the car. Okay. If it's only used, even though it's only used for 50% of business, what are you going to do? Well, if a passenger automobile predominantly for business qualifies, it could qualify for additional 15 or additional first year depreciation. So because that also works here. So first year recovery is increased by $8,000. That's the additional first. So limits increase from 10,000 to 18,000. I think the next show sides me. Oh, no. Okay. So what you're looking at then is, even though you got to look at how much you're using the car, and you're looking at if it's over 50%, those are your numbers. If it's less than 50%, then you have to straight line the depreciation. And now you can add if it's used predominantly for business, qualifies, it then qualifies for additional first year. Limits are for 100% business use, must reduce limits by percentage of personal use. So let's see if I said what I just said right or not. So if I use my car for 60% business, I then am going to, with the exception of the additional first year, I got to take that amount, that $10,000 times 60% plus 8,000. Except for the fact that it's, unless it's 100%. So does that make sense? So I wouldn't hit my $40,000 car in the first year. So in year 1, if I used it for 60%, I'd take 60% times 10,000, so $6,000. But in year 1, I'd also get another 8,000. So I'd get $14,000 in year 1. In year 2, I'd get 60,000 times 16. In year 3, I'd get 60%, times 9,600. And then in year 4, I'd get 60% times 57,600. And then I would have to go at least into into a couple more years of 57.6 times 60% to get my $40,000. But as soon as I hit 40,000, even though I might be in year 6 or 7, I'd have to stop at 40. If my car costs $40,000 exactly, I have to stop at $40,000. Oh, here's the example. I thought I had one, but then I thought it disappeared. So we acquired an auto of $55,000 and used it 80%. 55,000 times 20% times 80% gives us the 8,800, but the deduction is limited. So where'd they get the 88? Oh, because they decided not to take the additional first year deduction. So they had to limit cost recovery allowance is 8,000. So they get 20%. So they only used it in 80% of the business. And then let's look at the next one. Okay, so then we got another type of car. We got a car that it goes over a certain amount of limit, a pound. When you have a car that is not subject to statutory dollar amounts, then that section 179 is up to 25,500. All right, so the the pound limit is 6,000 pounds to 14,000 pounds. So that's a bigger, I don't know if you're familiar with it, but that's a heavier car. It usually goes up in weight to a bigger SUV type car or passenger automobile. And I think that's all it actually I think that's all it says on that. Yeah. But I want to go back and look at one thing on this one. And then make sure I didn't miss something. No? Okay. I thought I saw something that threw me off, so I was just looking at something. Okay. All right. So, but anyway, so those vehicles, then the dollar amount imposed, it's not, there's a higher dollar amount, that's all. Okay. We went through that. If the car changes from predominantly used business, then you have to recapture those amounts going forward. Kind of a big pain in the butt. So it kind of how I told you, don't put something on your taxes if you think it's going to come back. Sometimes this is harder to do if you change jobs and you no longer drive your car for work or anything like that. You might have to go back and go through. So the amount recaptured has to be done as ordinary income. So you have to claim that income on your tax return. Leased incomes, auto, are subject to inclusion amount. You can use the tax tables to come up with this, but including leased cars is a little bit trickier. And this was one of the charts that I showed you about, the ADS, alternate depreciation. It's used when you're using AMT. We haven't done the chapter on AMT. That's chapter 12, alternate minimum tax. But it's used to get depreciation on allowance for earnings and profit. So residential and non-residential real estate and improvements placed in service after 2017. All right. And so they opt out of some things for section what's called 163J. And in general, the interest expense limitation on there, it's usually they're going to use what's called straight line without regard to salvage value. I'm not as familiar with that, but there's a chart set up with Mackers for ADS with straight line. And it's for rental real estate property that is going to follow that with regards to AMT. And so when we talk to AMT, we won't jump back to this, but I will reference the fact that they kind of have their own depreciation methods. AMT for 1.5 declining value, they do still have half quarter, mid quarter, and mid month. Right. And basically, it's to hopefully simplify reporting, which is Ardan was mentioning he wanted. It's to simplify the reporting. I don't know that it necessarily does. If this election is made, there's no difference between regular income tax and AMT cost recovery. And then the last part is the very last part of your 4562. It is amortization. Now, there are 44 lines on the depreciation form. 42, 43, and 44 are amortization. So you do not see near as much with amortization because there are only two intangibles that can be depreciated. Patents, which are probably going to be the most common ones you see on here. Because when I mentioned copyright and I said 70 years past the death of the creator, you just kind of looked at me funny like, when are we going to start that? Exactly. And copyrights, besides the fact that it's 70 years past the death of the creator that you're going to start the copyright of it, you don't see a lot of them on the small businesses, but you do see a lot of patents for small businesses. So that you see a lot more of. So that's on the bottom. They can claim amortization deductions on 197 intangibles. They do straight line over 15 years beginning in the month that the patent or the intangible is acquired. Notice, for tax purposes, it's 15 years. Okay, but for financial purposes, it's over the life of the asset. So it is a difference between tax and financial. So it doesn't matter here that it could be a 20-year patent or 70-year copyright or 5-year patent. 15 years, 180 months, straight line. All right? It includes, now notice, intangibles include, but you have to have, oh, did I just say something wrong? I'm going to have to check into what I just talked about. So for financial purposes, the only patents that you can the only intangibles that you can amortize are copyrights and patents because they have to have a limited life, which we just talked about earlier. One of the things that popped up was it had to have a limited life. However, this little wonderful slide just popped up and said, Section 197, you can claim amortization deductions on Section 197 intangibles. And then they go on to say, it's not just copyrights and patents. They include goodwill, franchises, trademarks, and covenants not to compete, non-compete clauses. So I'm going to have to look into that. Some of you might not care. Some of you do care. As to why those that do not have a limited life will be included in that. So I will have to look and see. I can tell you that the startup expenditures and all that would be included in the cost. That's the same as financial accounting. And you can deduct the lesser of those amounts. You can't deduct everything. And any amount that's not deducted can be amortized over the 180-month period that the amortization begins. So now I'm really curious, though. That's an empty slide. If we go back to the refocus, we already kind of talked about his computers, and we already talked about 197. We already went through that, so that we know, and then that's the last slide. So I will have to go through, and I will let you guys know. I'll try to send out an email for those that are curious why we can amortize things that don't have a life. I find that kind of interesting, especially things. Now, for tax purposes, it's much easier to say amortize it over 15 years than for something in financial accounting. But I still, I find that interesting. So I will find out what that is. So next week, we will talk about a little review. It's not, I usually give you a little bit of just kind of what to study for the midterm. I will tell you that sometimes some find the midterm harder only because I don't know that you know what to expect. You usually do better on the final than you do the midterm. Only because I think you go into it not knowing what to expect. Even though I'm telling you what to expect, it's still an online tax exam, I guess. I don't know. The biggest thing I'll tell you, and I'll tell you this next week too, is to write down on paper as you're taking the test. I give you 2.5 hours. It's more than enough time. Some people will use 1.5 hours and some people will use 2.5 hours. If you try to look up everything, you'll run out of time. So you still have to study. It's not a tax test where you're like, well, I got my book, I don't have to study. You still have to study for it. All right, and unfortunately, that's why I think some people don't do well, mainly online because they're not listening to me say this. You still have to study for a test. It depends on how you've been doing on everything that you've been doing in class. And you want to have your stuff organized. If you're not organized going to take it, then that's going to be a problem too if you're having to look everything up. So, but we'll talk about that next